Imagine turning a small investment into 10 times its value, not in decades, but within years. What if I told you that one of the greatest investors ever made this happen again and again, and he did it by simply paying attention to everyday life? His name is Peter Lynch, and during his time managing the Fidelity Magellan Fund, he crushed the market, averaging nearly 30% returns a year for over a decade. But here's the kicker. He didn't rely on complicated formulas or insider tips. Instead, he believed regular people like you and me have a secret weapon to beat Wall Street. In this video, we'll unpack Peter Lynch's One-Up on Wall Street, a timeless investing guide that shows how to identify promising stocks early, research them effectively, and invest with clarity and confidence. Part 1. Use your everyday edge. Lynch's most famous rule: invest in what you know. He believed ordinary people are often first to see trends in everyday life. Whether it's your favorite store, a product your kids obsess over, or a restaurant that's always packed. For example, he discovered big winners by listening to his wife and kids, like Legs Pantyhose and Dunkin' Donuts, before Wall Street analysts even paid attention. This doesn't mean buy everything you like. It means use what you see around you as a starting point for deeper research. Part 2. Do your homework. So, you found a company you love. Maybe the brand you use daily, or a product that's blowing up in your neighborhood. That's a great start. But Peter Lynch would say, now it's time to do your homework. Because liking a product isn't the same as investing in the company behind it. Here are 5 key questions Lynch recommends asking. 1. Is the company profitable? Are they making real money? Not just revenue, but actual profits? Look for consistent net income growth, not just top-line hype. 2. Is revenue growing? Are more people buying their product year after year? Growing sales equals growing opportunity. 3. Do they have too much debt? Can the company survive tough times? Or is it buried under loans? Check the debt-to-equity ratio for risk. 4. What's the P ratio? Are you paying a fair price for the company's earnings? Compare to peers to judge if it's undervalued. 5. Do I understand the business? If you can't explain how the company makes money in one sentence, don't buy it. Lynch's rule: know what you own and why you own it. Part 3. The 6 types of stocks. Peter Lynch says not all stocks are the same. He groups them into 6 types, each with different risks and rewards. 1. Slow growers. Mature companies with steady but slow growth, like utilities or big consumer brands. Safe but not exciting. 2. Stalwarts. Large, stable companies with moderate growth, like PepsiCo. Good for steady returns over time. 3. Fast growers. Smaller companies growing fast, like early Amazon or Shopify. High reward but more risk. 4. Cyclicals. Companies affected by the economy, like car makers or airlines. Profits go up and down with economic cycles. 5. Turnarounds. Struggling companies that might recover. Risky, but can pay off big if they bounce back. 6. Asset plays. Companies with valuable hidden assets, like land or patents, that the market doesn't fully value yet. Knowing what kind of stock you own helps you make smarter decisions. Are you okay with steady and safe, or do you want fast growth and are willing to take more risk? Lynch's categories help you decide. Part 4. What is a 10-bagger? Peter Lynch's famous idea of a 10-bagger is a stock that grows 10 times in value. Imagine buying a share for $10 and seeing it rise to $100 or more. These stocks can turn small investments into life-changing wealth. To find a 10-bagger, Lynch suggests, look for fast-growing companies that aren't yet widely known. These often start small but have big potential. Be patient and hold long-term. It can take years for a stock to multiply tenfold. Don't panic over short-term ups and downs. Do your research before others notice. Use your everyday observations and curiosity to spot trends early. Examples like Walmart in the 1980s or Apple in the early 2000s show how early investors who held on saw huge gains. Not every stock will become a 10-bagger, but focusing on strong businesses and holding patiently improves your chances. Part 5. When to sell. Lynch didn't trade stocks constantly. He held them for years, and his biggest wins came from being patient. He believed in buying right and holding through volatility, but also knowing when to move on. He sold only if the fundamentals changed, for example, declining earnings or bad management. The story changed, like new competition or fading industry. The company became significantly overvalued. He found a clearly better investment opportunity. Lynch emphasized that volatility is normal. Don't panic. Most people lose money because they sell too early or for emotional reasons. His golden rule: the key to making money in stocks is not to get scared out of them. Trust your research, stay informed, and avoid the noise. Investing success isn't luck. It's about curiosity, patience, and learning from what you see. You don't need to be an expert. Everyday people can find great opportunities by paying attention and doing their homework. It won't always be easy, but if you stay disciplined and trust your process, you can build lasting wealth. Your next big investment could be right in front of you. Take the first step with confidence, and your future self will thank you.